In today's episode, we're going to talk about whether you should buy stocks and when's the best time to do so. So don't forget to subscribe and turn on that notification bell so you stay up to date when new episodes come out. Tens of thousands of people turn to Google every month to see if now is the time to invest. It's a loaded question, especially this year in 2020. The S&P 500 began a month-long decline, finding what investors hope was the pandemic floor on March 23rd. Historically, it has taken an average of about 2 years for the market to recover from a crash. This time, however, it bounced back in just 149 days. By the end of August, the index was once again hitting record highs. Stranger still, this unprecedented recovery came amid bad headlines, with US unemployment hitting an all-time high in April and remaining above 10% through July. Between the stock market's erratic behavior and economic uncertainty across the globe, investors are understandably wary. But that shouldn't mean sitting out of the market. First, you need to understand the Main Street Wall Street disparity. The market's recovery is clearly at odds with the US economy, but a closer look shows that imbalance may not be as perplexing as it seems. The stock market reflects investor sentiment about the future, not what's happening right now. While retail investors may be more inclined to buy and sell based on daily headlines, institutional investors are looking far ahead. And given the rapid market recovery and the expectation of continued help from the Federal Reserve, it appears Wall Street isn't spooked. The S&P 500 is also market capped weight, meaning larger companies will have a bigger impact on its performance. The 5 largest companies in the index, Apple, Microsoft, Amazon, Facebook, and Google's parent company Alphabet, are in tech, an industry that hasn't been hit as hard by COVID-19. The tech-driven recovery helped push the S&P 500 to its record high, despite the ongoing economic issues caused by the pandemic. And then there are high hopes for an eventual vaccine. According to Robert M. Wyrick Jr., managing member and chief investment officer at Post Oak Private Wealth Advisors in Houston, investors may be betting on the belief that a coronavirus vaccine will be produced sooner rather than later. If and when a viable vaccine is broadly available, it's likely to be a big driver of continued growth in the markets. While this is likely already priced into the market to some degree, I would prefer not to be on the sideline when this ultimately happens. So next, let's talk about timing the market versus time in the market. According to Margarita Chang, a certified financial planner and CEO of Blue Ocean Global Wealth in Gatesburg, Maryland, when you start investing isn't as important as how long you stay invested, and that's a maxim to remember in a pandemic too. The best way to build wealth is to stay invested, but I know that can be challenging. It's easier if you invest only for long-term goals. Don't invest money you need in the next 5 years, as it's highly possible the stock or mutual fund you purchase will drop in value in the short term. If you need these funds for a large purchase or emergency, you may have to sell your investment before it has a chance to bounce back, resulting in a loss. But if you're invested for the long term, those short-term drops aren't of much a concern to you. It's the compounding gains over time that will help you hit your retirement or long-term financial goals. So lastly, I want to talk about the water's fine, but wade in slowly. One of the best strategies to remain calm and stay invested during times of volatility is a technique known as dollar cost averaging. Through this approach, you invest a specific dollar amount at regular intervals, say once or twice a month, rather than trying to time the market. In doing so, you're buying in at various prices that, in theory, average out over time. Wyrick notes that this is also an excellent strategy for first-time investors looking to enter the market during times of uncertainty. It's very difficult to time when to get into the market, and so there's no time like the present. I wouldn't go all in at once, but I think waiting around to see what happens to the economy or what happens to the market in the next 3, 6, or 9 months in most cases ends up being a fool's errand. So how exactly do you start dollar cost averaging into the market? A common strategy is to pair this with stock funds, such as exchange-traded funds. ETFs bundle many different stocks together, letting you get exposure to all of them through a single investment. For example, if you were to invest in an S&P 500 ETF, you would have a stake in every company listed in the index, rather than investing all your money in a few individual stocks. ETFs help you quickly build a well-diversified portfolio. To dollar cost average, you could set up an automatic monthly or weekly or bi-weekly investments into an ETF through your online brokerage account or retirement account. Through this approach, you would achieve the benefits of dollar cost averaging and diversification, all through a hands-off strategy designed for building wealth long term. So that's it for today's episode. Thank you for listening. More to come. And as always, take care of your money.